Warren Buffett is one of the most successful investors of all time, with a net worth of more than $96.5 billion as of August 2022. His patient, disciplined, and value-based investing approach has produced returns that have regularly beaten the market for years. Although average investors, or the rest of us, don't have the resources to invest in the same manner as Warren Buffett, but we can heed one of his constant pieces of advice. Low-cost index funds are the most wise choice for most investors. In today's video, we will discuss what you need to know about investing in index funds if you consider following his advice. Hello 101 community, welcome back to our YouTube channel. In this video, we're going to explain to you what index funds are and how to invest in index funds. Make sure you watch the video until the end. But before we begin, if you're new here, make sure to subscribe to our channel and turn on notifications to never miss any updates. So let's start. What is an index fund? An investment known as an index fund monitors a market index typically composed of stocks or bonds. Typically, index funds invest in every element that makes up the index they follow. They have fund managers who aim to ensure that the index fund performs identically to the index. Types of funds. Private funds and registered investment businesses are the two primary categories of funds. Under the 1940 Act, registered investment companies are subject to extensive disclosure and continuous compliance requirements. Securities issued by registered investment companies are eligible for public offering because they are likewise registered under the 1933 Act. The three types of registered investment businesses are mutual funds, closed-ended funds, and unit investment trusts. Mutual funds, commonly called open-end funds, are financial firms that continuously sell shares. Shares of mutual funds can be bought directly from the fund or a broker for the fund. The purchase price is equal to the net asset value per share of the fund plus any upfront fees or sales commissions. There are several different investment methods that mutual funds use. Mutual funds can be set up as stock, bond, index, money market, and ETFs. In contrast to mutual funds, which continuously sell shares, closed-end funds sell a certain number of shares during an IPO. In the secondary market, the shares are sold for a price that may be higher or lower than the fund's net asset value. Investors who want to withdraw their money from the investment must typically sell their shares on the secondary market. The reason is that closed-end funds are typically not cashable. Benefits of index funds. Diversification. The most obvious benefit of using index funds is that they quickly diversify your portfolio, reducing the chance of losing some or all of your money. Lower price. Index funds may have cheaper costs than other investment funds, including taxes and management fees, which is another significant advantage of investing in them. Lower turnover ratio. The turnover ratio calculates the percentage of holdings changed in a fund in a given year. For instance, if a fund invests in 100 stocks and swaps out 10 this year, the turnover ratio is 10%. Advantages of index funds. Little financial expertise is necessary. Comparing index investing to creating your portfolio is comparatively simple. Convenience. Index funds include hundreds of stocks that are extremely difficult to replicate personally. Why buy an index fund? Both actively managed and passively managed mutual funds are available. To beat the market, which is determined by a certain benchmark, such as the S&P 500, the management of an actively managed stock mutual fund continuously buys and sells equities. The active manager risks making poor choices and performing below the benchmark. Most actively managed funds lose money relative to their respective indexes, particularly over periods like 3 years or more. In contrast, the manager of a passively managed index fund merely aims to purchase and hold securities corresponding to the specific index to mirror the index's performance. Best investment for beginners. Actively managed funds have lagged behind index funds, ETFs, and mutual funds. They can be excellent investments, but not all of them are created equal. You might be able to figure out the answers on your own, or you could want assistance from an advisor. Best index fund provider. For the DIY crowd, Vanguard Investments is one of the greatest and most popular mutual fund providers. With the belief that low-cost index funds can offer the long-term investor higher returns, John C. Jack Bogle founded Vanguard. The late Bogle successfully and repeatedly showed the investing world that it is folly to try an actively managed method when a straightforward, inexpensive, passively managed index fund strategy may deliver greater results. Additionally, the company offers a variety of exchange-traded funds, ETFs, which are comparable to mutual funds. If you want to know more about ETFs and mutual funds, click on the link in the description to watch the detailed video. Fidelity Investments. Fidelity Investments is well known for being a provider of mutual funds and retirement services and products for employers and individuals, including 401k plans and IRAs. Fidelity, one of the world's biggest international financial services firms, was founded in 1946. Charles Schwab Corporation is a discount brokerage house that provides mutual funds and financial services to individual investors. Schwab was established in 1971 as First Commander Corporation and started providing brokerage services to people at a discount in 1975. Before it, stock market investing was generally seen as a privilege of the wealthy. Discount brokerage Schwab also offers a selection of mutual funds. Can I use a 401k to buy index funds? Some people believe investing is overly risky, while hoarding cash carries more risk. That's correct. If you don't invest your retirement funds, you'll lose money. Consider that you have $10,000. In 30 years, after accounting for inflation, it might be worth less than half of that if not invested. However, if you invest your 401k funds at a 7% return, you'll have more than $75,000 when you retire with no further contributions. What is a 401k? A retirement investment account provided by your company is called a 401k. This investing account is referred to as tax-advantaged because your annual contributions, which are typically a portion of each paycheck, reduce your taxable income. You are encouraged to start saving for retirement now by that tax incentive. After making a 401k contribution, you must select investments. Your contributions will otherwise be kept in a money market account. Typically, a 401k plan does not allow you to invest in particular businesses, such as just purchasing Amazon stock. Instead, you'll pick one or more exchange-traded funds or mutual funds which invest in various businesses and industries. Although the financial market offers thousands of funds, your company's 401k plan will provide a limited number of stock and bond funds, ranging from conservative to more aggressive. That's frequently for the best, as having too many options might confuse investors and reduce your earnings. No matter how much cash is provided to you, you will need to perform some study before making your decisions. Searching for each fund's name on Morningstar, an investment research company, is one technique to evaluate each one shown to you. You will be directed to the fund's profile page on Morningstar's website, where you may view information on the fees, historical performance, and the companies, industries, stocks, and bonds that make up the fund. A star rating from Morningstar is also given for each investment's performance. After selecting your investments, the wisest course of action is to leave your account alone and let the contributions accumulate. If you like the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and to take your future into your own hands, check the links in the video description. Let's get an overview of what types of index fund do exist. In this video, we will examine 8 different types of index funds that have developed over time. Number 1. Broad Market Index Fund. A broad market index fund attempts to mirror a significant portion of the investable stock market. For instance, an index fund that tracks the Nifty 500 index is a broad market index fund since it exposes investors to firms in various market capitalization and sectors. Number 2. Market Capitalization Index Funds. Size does matter. It is an adage that has been ingrained in our culture, especially when it comes to investing. The market capitalization of the companies is used to weigh the bulk of the various indices. For instance, market cap weighted indices like the Nifty 50, the Sensex, the Nifty Next 50, the Nifty Midcap 150, the Nifty Small Cap 250, and the Nifty 200. Number 3. Equal weight index funds. Opting for an equal weight index is one strategy to combat the over and underweightedness of a market cap weighted index. An equal weight index is one in which each stock has the same weight, to put it simply. Let's take the Nifty 50 index as an example of the index being considered. In this instance, the conceptual weight for every 50 companies is 2%. Number 4. Factor-based or smart beta index funds. The market capitalization technique is the method of establishing an index that is most frequently used. It does not need to be the sole option though. Additional characteristics such as the PE ratio, dividend yield, book value, cash flow, sales, etc. can also be valuable measures for creating an index. Additionally, these indicators are probably more effective at identifying companies with good valuations for an index portfolio. Number 5. Sector-based index funds. ETFs, or funds based on industries, are popular among investors. The goal is to invest in companies operating in the same sector or industry. For instance, each industry has index funds and ETFs, such as banking, technology, healthcare, infrastructure, and consumption. Number 6. International index funds. There were merely 3 or 4 passive overseas funds earlier in the year. However, there have been a lot of offerings in the international index fund market over the past 8 months. Several US-specific indices, including the NYSE FANG Plus Index, the S&P 500 Index, and the NASDAQ Index. Number 7. Debt index funds. When you invest in debt products, you run the risk of 2 main things. One is that changes in interest rates cause fluctuations in bond prices. Second is the credit risk, which is the possibility that some bonds will not be repaid because the bond issuer has defaulted. Number 8. Custom index funds. A typical index works on a one-size-fits-all principle. However, when more data processing capacity is made available, it helps pave the way for greater customization based on what the fund manager wants and what various investor groups are looking for. Custom indices have a role in this situation. ETF versus index fund versus mutual funds. Exchange-traded and index funds are investments that pool together various individual securities, such as stocks or bonds, that offers you a huge amount of diversification right away. Both fund types are typically passively managed, offering financial savings and excellent long-term returns. One of the main differences is how ETFs and index funds are exchanged. While index funds can only be traded at a price determined after the trading day, ETFs can be purchased and sold anytime. There are a few distinctions between mutual funds and index funds. While active mutual funds invest in a changeable list of securities selected by an investment manager, index funds invest in a predetermined list of securities, such as solely stocks of S&P 500 listed businesses. That's all for today's video. I hope you enjoyed it. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you will be notified of every update. Also, Don't forget to check the links in the video description. And while you're here, click to watch one of these 2 videos appearing on your screen right now. I will see you there. Take care and stay tuned.